Welcome to Mastering Accounting Basics. Congratulations on deciding to improve your QuickBooks skills. My name is Alana Millis, and I'll be one of the instructors you'll see throughout the training. You'll see me at the beginning of each chapter where I'll set the context and give you an idea of what you're about to learn. You'll also hear from me when a subject requires additional explanation outside of QuickBooks. Now, let's talk about what's covered in the first chapter. First, we review the goals of the training. Then, we answer the question, what is accounting? Next, we answer the question, why do you need accounting? You discover that accounting is an important decision tool and may be one of the most important functions of your business. You then learn about financial statements and the accounting equation. This will certainly impress your friends and neighbors. The chapter ends with the finer details of accounting. This is when you learn about double entry accounting and those pesky debits and credits you've probably heard about. Before we get started, it's important to note that we do not work in QuickBooks during the first two chapters. However, once you've built a foundation of accounting knowledge, you'll learn within QuickBooks.
The overall goal of this training is to help you understand accounting. You won't be a CPA at the end of this course, but this knowledge will help you use QuickBooks. Now let's review the specific goals for this training. First, you learn basic accounting concepts, like debits and credits. Second, you learn key accounting principles. These principles give you a much deeper understanding of accounting. Third, you learn how QuickBooks does your accounting. You learn how QuickBooks handles the chart of accounts, items, and the behind-the-scenes accounting for common transactions. Fourth, you learn to check your numbers for accuracy. After all, a report is of little value if the numbers are wrong. Fifth, you interpret and analyze financial statements. You'll learn techniques and tools accountants use to analyze the reports. These tools help you make better business decisions. Sixth, you learn the accounting cycle, what accounting tasks need to get done, and how to make sure they are completed on time. Seventh, improve how you work with your accountant. You learn the language of accounting and what to consider when establishing a client-accountant agreement. You also learn how to share your financial data with your accountant. Eighth, provide you with additional resources and checklists to help you with accounting. Take your time and enjoy yourself. Before you know it, you will have the accounting knowledge required to use QuickBooks more successfully. Now you learn about basic bookkeeping. Let's begin by answering the question, what is accounting? Accounting means different things to different people, but as a business owner or manager, the basic definition is a reliable, accurate record of business activity that helps you understand what's going on in your business and helps you make decisions. Let's look at this more closely. A broader definition of accounting has two parts. First, accounting shows you your business in terms of money. You can tell what you have in checking and savings. It also shows what you owe and what others owe you. How much your business is worth. Accounting doesn't just show cash. It includes equipment and materials you purchased and inventory you plan to sell. A way of measuring profit or loss. Accounting is like a financial scorecard of your business. Accounting is also the record of financial events. This is how you know what happened in your business. The second part of your definition is how you use accounting. Remember, an important element of accounting is how you use the information. Accounting is used to understand past events. This helps you answer questions like, which products or services are my best sellers? Or, which jobs are profitable? Having this information helps you plan for the future. For example, if a certain product or service is profitable, you may decide to sell more in the future. The information you get from your accounting records also helps you apply for a loan and calculate how much to pay in taxes. The real work or activity of accounting is record keeping. Let's talk about keeping good records. First, why should you keep accurate records? Because this information forms the basis for calculating taxes and running reports. If you enter bad information into QuickBooks, you get bad information out of QuickBooks. The next question is what to record. You should record the date and monetary value, who was involved, why you spent the money, or why you received the money. The next issue is how you should keep financial records. First, you should capture information in a timely manner. You can't use information if you wait weeks or months before entering it. You must be accurate, and the information should be recorded in a reliable way. To understand this record-keeping function, let's use a common example. You probably record personal bank activity in your checkbook. Imagine just guessing your checkbook balance. If you don't keep accurate records, you might bounce some checks. Many things affect your checking balance, but it comes down to two main things: money coming in and money going out. For example, you deposit a customer payment. The deposit increases your checking account balance. You should record the date you made the deposit, from whom you received the money, Smith Hardware, and you should categorize or explain the reason you received the money, in this case, income for services rendered. You must also record the amount of the deposit, $1,500. You just accounted for a deposit. See, it's not so hard. Now let's record money going out. You're hungry, so you go to Tom's Pizza Joint and buy a large pizza with everything on it. You pay Tom with a check. In your check register, you record the date you spent the money, who you gave the money to, Tom's Pizza Joint, and you categorize or explain the reason you spent the money, pizza for lunch. You also record the amount of the check, $16. So, how do these records help you? Now you can calculate your checkbook balance. The total money deposited minus the total money you spent equals your checkbook balance. If you want to understand why your checkbook balance is $12,651.15, review your checkbook register. In this example, you learned what to record. You record dates and monetary values, who was involved, and where and why you spent the money. This is where you label or categorize an expense. In accounting, you call this label an account. In the case of a deposit, you also record where and why you received the money. In other words, you categorize or label any money you collect. Remember, this label is called an account. Be sure to record this information in a timely, accurate, and reliable manner. If you don't, reports might be misleading, confusing, or inaccurate. To avoid this, keep your books up to date and enter transactions consistently. We'll talk more about how to do this as we go through this training. Remember, accounting is a reliable, accurate record of business activity that helps you understand what's going on in your business and helps you make decisions.
You use QuickBooks to do your accounting, but why do you need accounting? There are some obvious reasons, like to have the numbers for your tax return. Also, accounting provides information about what your business has, such as money in the bank and inventory in the warehouse, or what the business owes for payroll taxes and bank loans, and whether your company is making a profit or losing money. These reasons are all important, but accounting means even more than that. Accounting is about making decisions. Is your business growing too quickly? Should you hire that new employee? Are you spending your advertising dollars wisely? You get this information from accounting. But as you learn, if you don't enter information correctly, your accounting reports won't be accurate. Accurate and timely information is essential to running your business. Accounting reports tell you where you've been, where you are, and in many cases, where you're going. Accounting also allows you to share information about your business with others. Who needs this information? Maybe a person inside your company, like a manager, and people outside your company, like banks or investors. Unfortunately, they won't just take your word that you can pay back the bank loan. How do you give them this information? You have to make a formal statement about what your company is worth and how profitable you've been. In accounting, we call these financial statements. So, now you know why you need accounting, but what is accounting? You learn the answer in the next topic.
This topic introduces you to financial statements. Now you learn a broad overview of financial statements. You learn the finer details later. Financial statements provide a picture of your business. You need to know where your company stands and how much money you are making. All businesses produce two primary financial statements: the balance sheet and the profit and loss statement. First, let's learn about the balance sheet. The balance sheet is a financial picture of your company. It shows where you stand at one moment in time. The balance sheet is made up of three sections: assets, liabilities, and equity. Assets are what you own. Examples include your checking account balance, accounts receivable, inventory, and office equipment. Liabilities are what you owe to others. Examples include accounts payable, credit card debt, and loans. Equity shows what the business is really worth. If you sold the business, you would sell the assets and use the money to pay liabilities. The money you have left is equity. Here's the concept used in accounting. What you own is equal to what you owe plus what's left over for the owners. This is called the accounting equation. Assets equals liabilities plus equity. Let's look at this equation on the balance sheet. What you own, total assets of $3,150, equals what you owe, liabilities of $850, plus what's left for the owners, equity of $2,300. Look at your company's balance sheet, and you'll find the exact same equation, with different numbers. The profit and loss statement is the second financial statement. It shows your company's performance during a specified period of time. The profit and loss is comprised of three sections: income, cost of goods sold, and expenses. Income is what you earned. Examples include sales of products or services. Cost of goods sold is typically the cost of materials that went into a project or the cost of the inventory you've sold. Not all businesses have cost of goods sold, so don't be concerned if this section does not appear on your profit and loss statement. Expenses are what you spend. Examples include office supplies, rent, telephone, and utilities. The end result of your profit and loss statement is how much money the company made, net income. Calculate your company's net income by taking total income, minus any cost of goods sold, minus your expenses. Let's look at this calculation on the financial statement. On this profit and loss statement, total income is $3,300. Subtract cost of goods sold of $1,000 and expenses of $1,000. The result is a net income of $1,300. Here you see how the calculation works. You now have a general overview of basic accounting concepts. In the next topics, you learn the finer details of accounting.
Now you learn about accounts. This is confusing because of the different ways we use the word account in the real world. The word could mean explanation, like, please account for the increase in sales. Or it could mean story, such as, give me an account of how you closed the sale. Some businesses refer to customers as accounts. And finally, Some people assume account only refers to bank accounts. In accounting, the word has a very specific meaning. An account is the category or label you assign to a transaction. You use accounts every time you enter a transaction in QuickBooks. For instance, when you write a check for office supplies, you assign the dollars spent to an expense account. You wouldn't assign the dollars to rent expense or advertising expense. Instead, you assign the dollars to an account named office supplies. This way, when you run accounting reports, you'll see exactly how much you spent on office supplies. Your accounts are stored in a QuickBooks list called the chart of accounts. Consider the chart of accounts the hub of your accounting system. Every transaction you enter into QuickBooks affects the chart of accounts. For example, let's say your checking account has a balance of $10,000. What if you write a check for advertising for $1 million? Two things happen. Your checking account balance shows an overdraft of about $990,000, and the advertising account shows you spent $1 million on advertising. This check demonstrates a key point. Every transaction affects more than one account. For example, when you write that check, you decrease the checking account and increase advertising expense. This is called double entry accounting. Now you learn about double entry accounting and those challenging debits and credits. Why do I call these challenging? Because understanding the difference between debits and credits and when to use each could be the most difficult task you face with QuickBooks. Next, you learn about the theory of debits and credits, and don't be frustrated if you don't understand all the theory immediately. You'll still be able to use QuickBooks successfully.
Now you learn about double entry accounting. What does the term double entry accounting mean? This means there are always at least two things involved in every financial transaction. When you receive money or something of value, it must come from somewhere. Let's call this the source. When you spend money or something of value, it must go somewhere. Let's call this the use. Double entry accounting means that every financial transaction has a source and a use, and they are always equal in value. In other words, they are always in balance. Sources of money include income from the sale of a service or product, money you borrow, like a loan from the bank, sale of assets, perhaps you sell the company computer. Although you only receive $12, it is still considered a source of money. Let's look at some typical uses of money. These include expenses, like rent, utilities, and office supplies. Repayments, you have to repay that bank loan. Purchase of assets, you purchase a new computer to replace the old one, or you buy equipment or a new company automobile. Remember the checkbook example used earlier? You earned wages and the money went into your checking account. The source was your wages, and the use was the deposit into checking. You then bought a pizza. The money came from your checking account. So the source was your checking account, and the use was a delicious pizza, which you categorized or accounted for as meals. Business accounting works the same way. However, instead of wages, your business receives money from the sale of services and products. And instead of pizza, the business spends money on inventory, office supplies, job costs, and utilities. Personally, I prefer the pizza. It's important to understand that QuickBooks is a double entry accounting system. This means every transaction involves a source and a use. So far, you've learned the words source and use. In the next topic, you will learn the actual names used in accounting, debit and credit.
Now you learn about debits and credits. This is confusing because of how you might use the words debit and credit in the real world. For example, the word credit could mean praise, like, I give you credit for closing that sale. Or It could mean loan, such as you extend the new customer $10,000 of credit. It could mean ranking, like your business has a AAA credit rating. Next, you learn the accounting definition of these words, and you learn how to use debits and credits. As you'll see, double entry accounting simply means that every transaction has both debits and credits, and they must equal each other.
So far, we've described transactions with the words source and use. Now you're ready to learn about debits and credits. So what do these words really mean? The word debit means left side of a transaction, and credit means right side of a transaction. In double entry accounting, debits must equal credits, in the same way that source must equal use, as you learned earlier. In general, you debit the account that represents the use or where the value goes, and you credit the account that represents the source or where the value comes from. Please note, this is a general rule. There are exceptions, but this rule should help you understand the debits and credits for basic transactions. Certain types of accounts increase when you debit them. The debit accounts are assets, cost of goods sold, and expenses. Remember, a debit usually indicates the use or where money goes. If money goes to any of these accounts, their balance increases. Certain types of accounts increase when you credit them. The credit accounts are liabilities, equity, and income. Remember, a credit usually means source. If the source of money is from any of these accounts, their balance increases. Why do we use the terms left and right to describe debits and credits? Accountants use the letter T to represent accounts. This helps ensure that everything balances. The left side of the T is the debit, and the right side of the T is the credit. Any account can have a debit or a credit, but as you learned, most transactions tend to debit certain accounts and credit other accounts. So specific accounts tend to have a debit or credit balance. Accounts that carry debit balances are assets, cost of goods sold, and expenses. A debit increases the balances of these types of accounts. Accounts that carry credit balances are liabilities, equity, and income. A credit increases the balance of these types of accounts. Now let's apply this concept to real-world transactions. Congratulations! Your company is the leading supplier of doorknobs and doorknob installations in the world. Definitely a cause for celebration. A customer just paid $1,000 for installing a doorknob. Must have been a big doorknob. Let's draw T's to represent the accounts involved in this transaction. You deposited $1,000 into your checking account, so draw a T for your checking account. Now draw a T account to represent the service income account. You know that your checking account increased when the customer paid you, and service income increased from the doorknob installation. Let's put a reminder in the left corner to help you remember which accounts should be debited and which should be credited. You add $1,000 to your checking account balance with a debit because it is an asset. Remember, this is the use or where the money went. So using the general guideline, this is a debit. You must also add $1,000 to service income. Using the general guideline, the source, or where the money comes from, is usually a credit. In the next topic, you use T accounts to understand another transaction and then see how it affects your financial statements. You've learned to represent accounts with a T to see the debits and credits. Now you learn how these debits and credits flow to the financial statements. Congratulations, you are selling doorknobs like hotcakes and need to ship more. However, you don't have any shipping boxes. So you write a check for $600 of shipping boxes. First, let's draw T's to represent the accounts involved in the transaction. You increased your shipping expense, so first draw a T for the shipping expense account. Next, Draw a T account to represent your checking account. This is where the money came from. You know your shipping expense increased because of the purchase, and your checking account balance decreased when you paid for the boxes. As non-accountants, it's difficult to remember when to debit and credit accounts, so let's use our little helper. The helper on the left side shows you how to increase accounts, but in this case, we have to decrease the checking account. You decrease accounts in the exact opposite way you increase accounts. Let's use another helper to see this. This helper shows you how to decrease accounts. Note that the accounts on the left and right have switched sides. Remember, shipping expense goes up. Shipping was the use, and uses are usually debits. You add $600 to your shipping expense with a debit. This makes sense because debits increase an expense account. The money came out of your checking account. You subtract $600 from your checking account with a credit. Remember, the source of money is usually a credit. If debits increase assets, then credits decrease assets. How does this affect your financial statements? The checking account appears on the balance sheet. The balance is $600 less than the prior balance because of the check you wrote. What about the shipping expense? Expense accounts appear on the profit and loss statement, and here you see the shipping expense of $600. As you see, T accounts help you understand that debits must equal credits. If you remember which accounts increase with debits and decrease with credits, you will master one of the most important principles of double entry accounting. Remember, you don't have to understand debits and credits to use QuickBooks. As you learn later, QuickBooks automatically handles the double entry accounting for you.